Good morning, and welcome to today's webcast, Q4 Investing Insights, Macro and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news, that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in the slide deck and handouts widget. With that, I will turn it over to Dominic to get us started.
Thanks. Yeah, good morning and welcome to our third quarter installment of Macro and Markets. I'm Dominic Cellitti, Senior Financial Advisor with Moss Adams Wealth Advisors, and I'm joined as always by our Chief Investment Officer, Michelle Walker. So the third quarter certainly has felt a bit quieter than the first half of the year. Markets have continued to grind higher in somewhat of a stair-step fashion. Inflation seemingly been kept in check. Trade talks have been subdued, and corporate and consumer spending has not fundamentally slowed. Year to date, the Dow is up about 12%. The S&P 500 is up north of 17%, and the NASDAQ has been up more than 22%. Along with this, the bond index is up over 4%. Not too surprising, communication services and infotech have led the way, but we've also seen utilities and industrials participate, along with other areas of the market starting to see some cyclical benefits. The 10-year is also slowly falling. The Fed is poised to cut on their own terms. Stocks are up, bonds are up. So are things too good would be the question. Is there a bubble in AI? Is there a bubble in private credit? I think there might be a bubble in people talking about bubbles in reality. So we'll get to some of these headline risks shortly, but Michelle's going to take us through some more details on where returns have come from and how the economy is holding up in general.
Sure. Yeah. So let's start with the economy. The U.S. economy is showing some signs of cooling as we move through the start of Q4, particularly in the labor market, though overall activity remains fairly resilient. The most recent official jobs data is from August, where the unemployment rate rose to 4.3%. Up slightly from earlier in the year, signaling a softer, condition in the labor market, but not major job losses yet. Payroll growth has moderated, average weekly hours in manufacturing have declined some, and initial jobless claims have nudged higher, all painting a picture of a labor market that's easing but not collapsing. As it relates to inflation, market-based measures of forward-looking inflation expectations remain anchored, so we're not super worried about runaway prices, despite some lumpy tariff effects. September's consumer price index released last Friday came in slightly below forecasts. Categories like airfares, furniture, and apparel saw some modest gains, but owner-occupied rents, which is a key driver of CPI, continued to cool. Historically, sustained inflation has required both surging energy prices and rising quit rates, but we're seeing neither of those right now as oil has stayed largely range-bound this year and quit rates remain subdued. Consumption has remained resilient so far this year, supported by solid wage growth and steady retail activity. Retail sales were up nearly 5% year over year in August, though autos have softened a little bit as those incentives have wound down. With the personal savings rate falling below 5%, household spending is likely to slow some, but still contribute positively to growth. So second quarter US GDP growth came in pretty strong at 3.8%, but consensus expectations now point to a slowing Q4 and a full year 2025 growth range of around 1.6 to 1.9%, down from 2024's pace. The pullback reflects, fading consumer subsidies and the temporary impact of the recent government shutdown. However, fiscal spending, ongoing Federal Reserve easing, and strong investment in AI infrastructure remains meaningful tailwinds for medium-term growth. So let's talk about earnings season. So far for Q3, it's off to a good start with over 12% of the S&P 500 companies having reported so far. Approximately 87% of these companies have delivered a positive earnings per share surprise, and 84% have reported sales above expectations, which is above the historical averages. The blended earnings growth rate for Q3 is around 9.2% year over year, making it the 9th consecutive quarter of earnings growth for the index. Pretty impressive. The technology investment wave, particularly in AI and cloud infrastructure, continues to drive optimism, offering potential productivity gains, corporate margin support, and longer-term inflation control. As you can see in this next chart, earnings growth expectations for the S&P 500 remain in the double digits through 2027, and profit margins are expanding. As Dominic mentioned earlier, the leaders in the market for Q3 were once again information technology and communication services. However, in Q4 so far, the market is broadening out. As the Federal Reserve has restarted its rate cutting cycle, more interest rate sensitive sectors are joining the party. And the best performers so far in Q4 have been REITs and small caps. So it's been a minute since we've been able to say that. One reason is expectations around earnings growth. As you can see in this next chart, though the Mag 7 is expected to have 17% earnings growth in 2026, the other 493 stocks are expected to contribute a meaningful 12%, and that gap is much narrower than it has been. So speaking of the Fed and the Mag 7, this week should be pivotal for markets. The Fed's policy decision will come this Wednesday, with the market expecting a 25 basis point cut. Also, 5 of the Magnificent 7 tech leaders, including Alphabet, Microsoft, Meta, Amazon, and Apple, all report earnings, and investor focus will, of course, be on their commentary around AI spending. In addition, President Trump is scheduled to meet with Chinese President Xi Jinping on Thursday, and reports over the weekend suggest significant progress has already been made on a trade deal there. While heading into this week, market sentiment has been quite positive, although there in the background continues to be worries about how long this government shutdown will last. Volatility could definitely increase later this week, though, if the upcoming Fed meeting, earnings, or trade talks disappoint in any way.
All right, so let's talk about some recent recurring risk headlines that may not necessarily be causing much of a broad market reaction, but they're definitely creating some consternation for investors. In some cases, a little bit of pain in subsectors of the market. So what we've been hearing about most recently would be panic around risk and private credit, the proverbial AI bubble, investors wary of putting money to work when the market's at all-time highs, and what in the world is going on with gold and other commodities. So we're going to start with the credit market here. Earlier this month, 2 major bankruptcies brought the spotlight on credit markets. 2 companies in the auto parts and lending businesses that most probably haven't heard of, First Brands and Tricolor, announced major losses, with specifics still kind of unknown, but potentially tens of billions of dollars wiped out. This thrust private credit, which has been a popular topic, back into the headlines, given the asset class's prominence with the popularity and meteoric rise that it's seen in asset growth. Funny enough, these loans were made to businesses, but they weren't really in the private credit markets for the whole part. Most of these loans were done in what's called the broadly syndicated loan and collateralized loan obligation space. In other words, the traditional bank lending markets. UBS and Jefferies were the 2 major banks at the center of a vast majority of these liabilities. But as far as private credit goes, exposure that ended up in some private credit funds were pennies on the dollar in regards to the proportion of the total amount of assets. And most of those funds had position sizes that rounded to zero. So just to be clear, no private credit manager that Moss Adams Wealth Advisors utilizes had exposures to these borrowers. Regardless of that, what happened with these businesses, is it a sign for more bankruptcies to come would really be the question. Well, the first signs kind of point to no. Investigations are still ongoing, but it appears there's a large amount of deceptive financial practices, if not outright fraud. So both companies also have vast exposure to the lower end consumers. So there certainly could have been some pressure from slower spending in that part of the economy. But in our opinion, this story is kind of more of a story of the tides going out and these companies kind of getting caught without a bathing suit. So it also points to some lax due diligence and lending standards, in our opinion. To be clear, we don't want anybody to lose money, but I think the silver lining here in this instance was that every private credit or even public credit manager is probably taking a very serious look at their portfolio, reassessing risks, and it's also pulling investors and advisors such as ourselves in to make sure we understand what we own, who we're lending to, and what the lending standards are. It's typical that some loans go into default and some businesses struggle. That's part of the market. That's why you get paid for that risk. But poor due diligence and missing fraudulent practices is not really an acceptable standard. So in short, we do not believe there's a bubble in private credit that will lead to greater systemic risk. In general, we also don't see degradation in credit overall. Lending has not largely been impacted by corporate borrowers not being able to pay their loans or credit managers needing to charge in excess of current risk profiles, which you can see on the slide here. What we're looking at is credit spreads. It's the additional amount you charge for risky borrowing, and it really hasn't widened. The left side of the chart, the blue line is investment grade bonds, and the gray line is higher risk bonds or junk bonds potentially. That difference between the two is what's called the credit spread, and it's a gauge of stress. You see in 08, 09, and 2020, you see those blow out or widen. You need to be paid more for taking on greater risk in a greater risk environment. Right now, we just have not seen that, and it's not showing any degradation. On the right side, we're looking at default rates. And for the higher credit quality standards, defaults are essentially non-existent. And in the lower standards, they're at all-time lows, well below the ongoing average. So it's imperative to know what you're investing in, I think would be the moral of this story, and how you're selecting managers in the space, which is something we've talked about before. If we look at private credit on the right side of the slide, you'll see the dispersion between returns between top managers and bottom managers is a difference between 12% and about 5% returns. Most of these funds yield 10 to 11%. So what you're seeing in the lower end quality managers is significantly more defaults. That's why you need to, have proper manager selection in these things. It requires a lot more due diligence than just buying an ETF or a mutual fund. So let's move on from private credit. Michelle, can we talk a little bit about the AI bubble that everybody has been talking about?
So unlike many of the unprofitable startups during the dot-com bubble, the primary companies driving AI investment today are mega cap tech giants with strong balance sheets and significant non-AI related profits. As you can see here, the 5 largest hyperscalers, including Alphabet, Amazon, Meta, Microsoft, and Oracle, are fueling the vast majority of the CapEx spending, and importantly, they are doing so with their own free cash flow and not with debt. So while still in early stages, AI applications are already demonstrating real-world productivity increases, and this is a crucial difference from past tech cycles, where speculative value was mostly divorced from actual business activity. If you look at the chart on the right here, you'll see that AI adoption isn't just a tech sector phenomena. Industries like finance, healthcare, education, real estate, and manufacturing are all actively using AI to boost efficiency, streamline operations, and improve customer experience. This market opportunity just continues to broaden. No question, stock valuations for the leading AI companies are considered high, but they're not as high or as extreme as they were during the peak of the dot-com bubble. The growth in share prices has been more proportional to the powerful and sustained profit growth rather than purely speculative hype. Of course, there will always be corrections and valuation pullbacks along the way. We expect that, and that's normal. As Jeff Bezos has said, not every AI investment will succeed, but the broader economic and societal benefits could be enormous. We share that view. Analysts at Goldman Sachs recently estimate that full-scale AI adoption could add trillions of dollars to global GDP over the next decade, far exceeding the initial investment costs. Even so, it's critical not to concentrate too heavily in one theme. Our philosophy remains centered on broad market participation and disciplined global diversification, capturing opportunity while managing risk. In addition to tech, we like US cyclicals like industrials and small caps, which should benefit from stable growth and supply chain onshoring and reshoring. We like utilities tied to the growing power demand from data centers and electrification trends. Real estate, which stands to recover as interest rates decline. Developed international markets offer manufacturing and financial exposure at more reasonable valuations, and active emerging market strategies with preferences for infrastructure-linked businesses. We like India in particular, where infrastructure build-out is still in its early stages. And finally, our portfolios stay anchored by institutional quality fixed income and private investments, providing income stability and additional diversification as market dynamics evolve.
All right, like I said before, we're at all-time highs. And I think actually as of this moment, we're touching all-time highs today again. So what do you do if you have cash on the sidelines or you're still in the accumulation phase of your journey and we're at all-time highs? As always, my opinion is the best time to invest is now. Over the long term, the market goes up. It grows with the economy. And the longer your investment time horizon, the more this is applicable, and the less likely you'll even notice current drawdowns over time. So even at all-time highs, yes, especially at all-time highs, as we can see on the chart here. So if you look at the slide and you start on the right side, we're looking at investing at all-time highs versus investing on any day. What you see is over various timelines, whether that's 3 months or 5 years, you're typically going to have a higher return when you invest at an all-time high. Obviously, the shorter the time horizon, the more short-term volatility you're going to experience. So as time goes on, you see a greater dispersion in those returns. Now, if you look to the left, a little bit tough to see, so I'm going to walk through this chart or talk through it. You're seeing that all-time highs about a third of the time act as a market floor that the market never falls back through. So say this another way, we hit an all-time high and it creates this support under the market where we don't return to levels prior to that all-time high. Now, the market doesn't have a definitive answer why this happens, but from a technical aspect, a technical trading aspect, this typically happens because you have cash that missed the previous high, come back in at this level of support. It's a familiar level to a lot of people, and it marks this area where they know the market's been before. So the supply-demand characteristics of the market kick in, cash comes in, and you get this higher support at these levels. So in summary, don't let all-time highs prevent you from investing. All right, on to the next topic. Michelle, can you dive a little bit deeper into the Fed and what's going on with gold lately?
Yeah, so the Federal Reserve has clearly shifted to a more supportive policy stance this fall, responding to signs again of that softness in the labor market and steadier inflation trends. After restarting its rate cutting cycle with a quarter-point reduction in September, moving the federal funds rate to a range of 4 to 4.25, the Fed is widely expected to cut rates again this week on Wednesday, likely bringing the target down another quarter point. This move is driven by cooling employment data and ongoing concerns about economic growth, including the impact of the recent government shutdown. In addition to adjusting interest rates, the Federal Reserve has been signaling that its program of quantitative tightening, sometimes called QT, which has steadily reduced its balance sheet over time, may also end soon. And that's a step which would further ease financial conditions and provide more support to both borrowers and markets. Bond market reaction has been positive, with yields declining from recent highs as the outlook for rate cuts grows firmer. Lower rates benefits the prices of existing bonds and also improves conditions for borrowers. Okay, so let's talk about gold. It's been making the news as well. Gold has experienced a dramatic surge in 2025, making headlines for reporting, record high after high, along with intense volatility. After rallying more than 50% year to date, gold reached an all-time high earlier in October before undergoing a sharp correction, with prices falling over 6% in the steepest two-day decline since 2013. The rally has been fueled by several factors: strong demand from central banks and risk-averse investors amid geopolitical uncertainties, expectations for US Fed rate cuts, a weaker dollar, and then perceived risks, of course, in the equity markets. Recent profit taking, producer hedging, shifts in central bank demand, and unwinding of leveraged positions all contributed to this October sell-off we've seen. I believe gold, as of today, last I checked, is now down about 11% from its recent high. So we always watch gold. However, there are several core reasons why gold struggles as a fundamental investment. Unlike stocks or bonds, gold does not generate any income or pay dividends or compound returns. Your gains depend entirely on price appreciation, which can be really unpredictable and volatile. Over time, this lack of income creates a persistent opportunity cost, especially compared to assets that grow through reinvested earnings or interest payments. Gold also faces hidden costs such as storage and insurance and verification, which eat into long-term returns as well. Fundamentally, gold's price is driven mostly by investor sentiment rather than an underlying business or technology or consumption demand. It has limited industrial applications, so when investment appetite wanes like it has this month, there's no natural floor, exposing holders to sharp drawdowns. So institutions generally keep allocations low in gold, often around 5% or less. And we think that reflects the consensus that gold is a great natural hedge, but not in our view, a portfolio cornerstone. So Dominic, how's the consumer looking?
So as usual, let's start off with the consumer balance sheet. On the left side of the slide here, not much of a change from last time. Consumer is still not overtly levered. They have about 10% of their balance sheet in liabilities, and about 2/3 of those liabilities are backed by real assets, which is healthy. That's what we want to see. On the top right side, we see a proportion of how much they possibly could spend that they're spending on debt or debt service coverage. So it's at about 11%, still just under the long-term average and not at a level that's concerning by any means. Bottom right, similar to last time, we don't see any major changes. Auto, credit card, and mortgage delinquencies have kind of trended sideways. And the spike in student loans is a data anomaly I touched on last time, which is essentially a resumption of tracking those loans prior to the pause due to COVID. So overall, not any major cracks that we're seeing so far. We do, however, look at the consumer in aggregate. And in aggregate, the consumer does look healthy. The caveat would be the consumer as a whole still does not feel great. Consumer confidence is still at near all-time lows. This is survey data, and as usual, I say take this with a grain of salt. I would be bearish on one thing, that would be survey data. But in aggregate, there's some viable reasons for this negativity, in our opinion. Everything is more expensive. We all went through a decade of inflation in about 2 years. A lot of people are locked out of buying a home. Others are locked into low fixed mortgages, which sounds like a good problem to have, but it does create some stagnation in regards to mobility. And then lastly, the job market is really confusing. Immigration being at a standstill has created some issues with the supply of workers. Younger workers are having significantly tougher time finding entry-level jobs. And you have this ghost sector of the labor market where baby boomers are retiring and they're simply not being replaced. So we aren't seeing outright layoffs, but in reality, there are fewer job openings. Now, on the plus side, we have more people than ever participating in stock ownership. That stock ownership is definitely concentrated at the top end of the wealth spectrum, but that broadening out in participation is a great thing if more people can benefit in the growth of the economy. And not to brag, but the U.S. has one of the least concentrated ownerships of equities across the wealth spectrum, so better than most in the developed world. So it doesn't fix the story of two consumers, which is what you're also probably hearing being called the K-shaped economy. Top half is doing really well, participating in asset ownership, seeing wage growth and spending as they please. And the bottom half is struggling. Inflation is hitting them harder. Greater proportion of their spending is out of necessity as opposed to discretionary. So they're not really participating in the asset growth as well on the upside. Mentioned last time, top 10% of households spend or account for about 50% of consumer spending, and we continue to see that rise. So the high-end consumer is propping up our economy. The economy is doing well, that's great. But as soon as the economy starts to suffer and that cracks, that concentration could create some real problems. So we'd love to see some broadening out here, both in regard to spending and the continued trend of asset ownership. So moving on to the subject that could see some broadening and relief in the full consumer spectrum, and that would be housing affordability. On the slide, you can see how tough the housing market is in aggregate. The left side of the slide, see how unaffordable home purchases are. On the right side, we see the median first-time home buyer is getting older and older, and those work in tandem, essentially, taking longer to save for a down payment and needing a higher income to qualify for the median home price. So I think two things would help here. Obviously, with the lowering of rates, we'd see housing affordability potentially come back. We'd also see potential wage growth with lower corporate expenses. And then deregulation in housing starts. We have a lack of housing supply, and if there's more housing available, there's a supply-demand problem right now. We could potentially solve some of that supply issue. So a lot on the consumer. I'm just going to hand it off here to Michelle to touch on a macro opportunity that we talk about a lot, and that'd be infrastructure.
Yeah, thanks, Dominic. So yeah, this chart here on the left highlights just how large the funding gaps are for key U.S. infrastructure sectors over the next decade, with categories like roads, water, and power each facing needs in the trillions of dollars. Infrastructure is the backbone of economic growth and resilience, and both federal and state policymakers from both parties, as well as the private sector, are prioritizing upgrades. After decades of underinvestment, the urgency to modernize is higher than ever. Large federal programs have improved conditions in some areas, but private capital, typically through public-private partnerships, will be essential in closing remaining gaps, creating ongoing investment opportunities in utilities, power transmission, digital networks, and specialty funds. The investment opportunity in U.S. infrastructure is secular and multi-sectoral, stretching across modernization, the energy transition, broadband expansion, climate resilience, and adaptive systems. Public policy and long-term demand layered with private capital mobilization create a supportive backdrop for investors able to target these themes. In short, closing the U.S. infrastructure funding gap is not only critical for future prosperity, but offers investors access to durable, diversified growth drivers in a policy-backed environment. So Dominic, tell us what opportunities you're seeing in infrastructure and private investments in general.
Yeah, so I know we've got a few minutes left here, so I'll wrap up with a few of the spaces that we like. So in general, private markets, again, why do we add to private market exposure in our portfolios? In short, on the screen here, you can see public market portfolios with different variances of risk. When you add private exposure or alternative assets to them, we move portfolios up into the left. Higher returns, lower volatility, which is a proxy for risk. So that's the benefit we're getting out of exposure to these additional asset classes. So what do we like in private markets right now? We like adding exposure to direct real estate, infrastructure, and private equity secondaries. We maintain exposure to high quality private credit, as I mentioned, private equity primary deals. We also think venture capital and certain AI-related themes is appealing for high-risk investors as a proportion of private equity exposure, and we continue to avoid hedge funds and structured notes. So a few of the areas I mentioned that we're adding exposure to. Direct real estate, significant repricing since 2022. This past winter and spring, we think we kind of hit a trough in that pricing. A lot of that was due to interest rate shocks after the 2022 and 2023 rate hike cycle. And at this point, we've seen current cost of real estate drop down below the replacement cost of build. And what that typically tells us is that it's a signal that we're going to see a reversion, since existing properties usually are more costly than the cost of build, given the operational nature that they're in. Infrastructure, as Michelle mentioned, has a significant amount of tailwinds working with it right now. So it's another area that we love. Michelle mentioned the drivers behind the returns. I would also like to add the fact that this is one of the biggest diversifiers from an asset class perspective. Infrastructure has significant inflation protection, built contracts with these underlying properties, as well as the income and tax efficiency that you typically see with real estate investments as well. Lastly would be private equity secondaries. We continue to enjoy the benefits of buying assets at a discount when you can, working with the appropriate managers to find those discounts, as an opportunistic exposure within the private markets. So I'll hand it back over to Michelle to wrap us up here.
Yeah, so just quickly, the US economy continues to demonstrate resilience supported by low unemployment, steady inflation expectations, and solid corporate earnings growth. And we maintain a very constructive outlook, I mean, based on many things: expanding infrastructure investment, ongoing deregulation, onshoring momentum, accommodative monetary policy, and targeted tax incentives. Collectively, these all support, a strong economic scenario going into 2026. So I'll turn it back to our moderators. I think they have a few seconds to close us out. Thanks everyone for your time.
All right, thank you, Michelle and Dominic, for a great presentation today. If you submitted questions today, we will do our best to follow up with you after the webcast. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance upward. Thank you for joining us, and we hope you'll join us again next time.
Thank you.